Good morning. Sitting in for Mikey Oreta, I'm Robert Tan. From markets to policy, from Manila to the world, we cut through the noise so you can navigate, adapt, and lead. This is Business 360. Prices for oil and fuel cargo smash record highs as escalation in the Middle East soars, while the local currency jumps past 60 pesos to the dollar. Several European countries and Japan are now ready to help secure the Strait of Hormuz after earlier hesitation from some allies. Global debt watcher Fitch warns that the Iran war could threaten the Philippines' bid for an A credit rating. And the world tour of K-pop group BTS is expected to surpass Taylor Swift's record-breaking eras. The widening conflict in the Middle East is casting a darker shadow over the global energy outlook and the Philippine economy, which relies heavily on imported oil. The benchmark Brent crude hit a session high of $119 per barrel Thursday before settling at around $109. Investment bank Goldman Sachs says if outages persist, Brent could surpass its all-time high of $147.50 during the 2008 financial crisis. Meanwhile, the benchmark Dubai crude hit a record of more than $166 a barrel, while European and African cargoes are now trading around $120. Even Russian barrels have climbed back above $100. The Philippines is looking at Russia as an alternative supply source as the war disrupts energy flows from the Middle East. Iranian attacks wiped out almost 20% of Qatar's liquefied natural gas export capacity for up to 5 years. That's according to the CEO of Qatar Energy, Saad Al-Kaabi, who says the strike caused an estimated $20 billion in lost annual revenue. He adds that this puts LNG supplies to Europe and Asia under threat. Al-Kaabi, who is also Qatar's Minister of State for Energy Affairs, says he never imagined Qatar and the region would face such an attack, especially from a fellow Muslim country during Ramadan. Saudi Arabia says it reserves the right to take military action against Iran after it launched ballistic missiles in Riyadh. Riyadh is accusing Tehran of hostile actions against its neighbors, both directly and through regional proxies. Saudi's foreign minister says the kingdom still prefers diplomacy, but notes that there will be nothing that can reestablish trust if Iran does not stop.
And I think that's the clearest signal of how Iran feels about diplomacy. It doesn't believe in talking to its neighbors. It tries to pressure its neighbors. And what I can say categorically, that's not going to work. The kingdom is not going to succumb to pressure.
Iran, for its part, called the remarks unfair and one-sided. U.S. President Donald Trump tells Israel not to repeat its attacks on Iranian natural gas infrastructure. Oil prices jumped after Iran responded to an Israeli strike on South Pars gas field by hitting the Ras Laffan industrial city in Qatar. This is a key global liquefied natural gas hub, and the damage may take years to repair. Trump said the United States knew nothing about the attack.
I told him don't do that, and he won't do that. We didn't discuss. We do. We're independent. We get along great. It's coordinated, but on occasion he'll do something, and if I don't like it, and so we're not doing that anymore.
Israel admitted it acted alone in the strike and confirmed that Trump asked them to hold off further attacks. U.S. President Donald Trump threatens to blow up the world's largest gas field located in Iran if it will not stop its attacks in Qatar. In a Truth Social post, Trump warned the U.S. could strike the South Pars gas field with unprecedented force. He says he does not want to authorize this level of destruction unless necessary. Leading European nations and Japan expressed readiness to help the United States secure the Strait of Hormuz. Britain, France, Germany, Japan, Italy, and the Netherlands issued a joint statement saying they are ready to contribute in ensuring safe passage through the waterway. They said they would take steps to stabilize energy markets, including working with certain producing nations to increase output. The countries also, quote, condemned in the strongest terms the recent attacks by Iran, as well as the de facto closure of Hormuz. Japan's prime minister condemns Iran's action in the Strait of Hormuz. Sanae Takaichi says the conflict is hurting the global economy. She claimed that only U.S. President Donald Trump could achieve peace. Takaichi is in Washington on her first official visit, where she and Trump reaffirmed strong U.S.-Japan ties.
Japan condemns Iran's actions, such as attacking the neighboring region and also the effective closure of the Strait of Hormuz. As a matter of fact, my fellow minister, Foreign Minister Motegi, also had a direct exchange with the Iranian foreign minister and urged Iran to stop such activities.
We're going to be speaking about it today. We've had tremendous support and relationship with Japan on everything. And I believe that based on statements that were given to us yesterday, the day before yesterday, having to do with Japan, they are really stepping up to the plate. Yes, unlike NATO.
U.S. President Donald Trump jokes about Japan's Pearl Harbor attack to explain the surprise strike on Iran. He made the remark while defending actions against Iran during a meeting with Japanese Prime Minister Sanae Takaichi in Washington.
Who knows better about surprise than Japan? Okay, why didn't you tell me about Pearl Harbor? You believe in surprise, I think, much more so than us. And we had to surprise them, and we did. And because of that surprise, we knocked out, the first 2 days, we probably knocked out 50% of what we, and much more than we anticipated doing.
The 1941 Pearl Harbor attack killed more than 2,000 Americans and prompted the U.S. to declare war on Japan. President Bongbong Marcos said the Philippines will import coal to ensure sufficient energy supply across the country amid the Middle East tensions. Marcos says the move is meant to ensure the country has enough raw materials to keep power plants running.
The other thing is the power plants, yung kanilang raw material, especially the coal. We were trying to move away from coal, but because of this crisis, we'll open up again the importation, the buying of coal para hindi makulangan ang ating power plant, para sapat ang ating magiging power supply for especially in all parts of the Philippines.
Economist Joey Salceda sees the peso hitting 62 pesos to the dollar before it stabilizes. Salceda's statement comes after the local currency closed at more than 60 pesos to the dollar yesterday. He called on the public not to panic and said his forecast would not be a catastrophe, noting that the exchange rate simply adjusts to facts on the ground. Salceda adds that authorities are managing the currency slide without defending a fixed level, while remittances and exports provide partial offsets. He noted that a weaker peso makes the country cheaper for foreign tourists, creating an opportunity to boost arrivals if properly organized. More stories when we return. Business 360 will be right back. The Philippines' push for an A credit rating faces risks as oil shocks and slowing growth threaten its outlook. An analyst from Fitch Ratings says higher oil prices from the Middle East conflict could drive inflation, widen the current account deficit, and drag economic growth. The economy, already weakened by a recent slowdown and lower public spending, is expected to recover but at a more gradual pace than earlier projected. Fitch warns that prolonged shocks could delay fiscal consolidation and create negative pressure on the country's credit rating. The Philippine economy is set to grow below its potential through 2028, according to the World Bank. The lender forecasts GDP growth of 4.6% in 2026, rising gradually in the following years but remaining below government targets. It says growth will be held back by weaker public investment and anti-corruption measures through private consumption, investment, and exports are expected to support recovery. The World Bank adds that the outlook remains moderate, with conditions expected to improve only gradually over the next few years. The Department of Budget and Management, or DBM, releases 21.5 billion pesos to keep infrastructure projects running and buffer against global shocks. DBM says the funds were fast-tracked to ensure critical services continue amid higher oil prices. The department notes every peso released is meant to ease burdens, sustain livelihoods, and keep services running for the people. The Philippines posted a $2.3 billion balance of payments deficit in February, adding to pressure on the country's external position. The Bangko Sentral ng Pilipinas says the two-month deficit reached $2.7 billion as of February. Gross international reserves rose to more than $113 billion, enough to cover around 7 months of imports and foreign payments. The central bank says these reserves provide dollar liquidity and help buffer the economy against external shocks. The Philippines and Indonesia are in talks for a possible visit of Indonesian President Prabowo Subianto to Manila, but the schedule has yet to be finalized. Sources say the trip would include talks with President Bongbong Marcos aimed at further strengthening bilateral ties. Officials say the visit could happen as early as next week, though no date has been confirmed. Prabowo last visited Manila in September 2024, while Marcos chose Indonesia for his first state visit in 2022. Ties were also highlighted by Indonesia's last-minute reprieve for death row Filipina drug convict Mary Jane Veloso. The Philippine Coconut Authority pushes back against President Marcos' bid to suspend the mandatory biodiesel blend, warning it would hurt farmers and industrial investments. The House-approved bill would allow temporary use of imported biofuel to keep pump prices stable during global supply volatility. The PCA says this move could lower copra and coconut oil prices, threaten jobs, and undermine domestic coconut methyl ester production. The agency calls for a balanced approach, supporting the current B3 blend while monitoring market conditions. Consumers are not the only ones tightening their belts amid rising oil prices. Manufacturing companies are also moving to cut costs. The Federation of Philippine Industries says factories are adopting various strategies to conserve energy, including adjusting work schedules. But despite pressures from the Middle East crisis, the group assures there will be no layoffs.
There are some mitigating factors that we can do. So there are some that would do, let's say, 4 days or 5 days, because there are some factories that are actually working 6 days a week. So it could be that we would lessen it for the number of days for the week, but it doesn't mean that we're going to let go of people. It really is too soon to even talk about that.
The Department of Transportation cuts MRT-3 and LRT-2 fares by 50% starting March 23 amid fuel price pressures. The DOTR says the discount applies to Blue Beep card holders. Single journey tickets will also be cut by half, while existing discounts for senior citizens, PWDs, and students will remain in place. The measure follows President Marcos' directive to mitigate the impact of the Middle East conflict on transport costs. The DOTR says the discount will stay until further notice, while talks are underway to extend the measure to LRT-1 passengers. It's day 2 of the nationwide strike in Metro Manila. Drivers take to the streets to call for higher fares and subsidies, as well as faster government action. Jeepney drivers say diesel at 120 pesos per liter pushes daily fuel costs to 3,600 pesos, a burden they say could have been eased by the suspended 1 to 2 peso fare hike. The group plans to march to Mendiola this afternoon to bring their concerns directly to Malacanang. As for the strike yesterday, Piston said it affected 90% of the capital's main roads, though the MMDA reported normal traffic and no stranded commuters. We have more stories coming up. Stay tuned to Business 360. Central banks around the world hold interest rates amid the Middle East conflict and surging energy costs. The Bank of England kept its benchmark rate at 3.75%, citing risks to household and business costs from higher energy prices. Other major banks, including the Swiss National Bank, Sweden's Riksbank, the European Central Bank, the Bank of Japan, and the Bank of Canada, also maintained rates to monitor inflation and economic activity. These central banks warn that energy price volatility and global risks will continue to guide future monetary policy decisions. HSBC Holdings is reportedly looking to cut jobs in the coming years. Bloomberg reports the plan could affect about 20,000 roles or 10% of the bank's workforce. The report adds non-client-facing roles in global service centers are expected to be hit most as HSBC shifts toward artificial intelligence. But this assessment is still in the early stages. Let's take a look at how global markets closed overnight. Wall Street closed lower as shares of Micron Technology and Tesla fell amid investor concerns that soaring oil prices could keep inflation high and limit the chances of future interest rate cuts.
We have another down day on Wall Street in the wake of the Fed just basically saying they're not going to lower rates. The Fed saying that inflation is a little bit higher than they wish it would be. Unemployment is a little bit worse than they wish it would be. And that the conflict or war in Iran is not really helping matters.
The Dow Jones dropped 0.4%. The S&P 500 dipped almost 0.3%, while the Nasdaq fell nearly 0.3%. European markets also closed lower. London's FTSE 100 dropped over 2%. Germany's DAX dipped nearly 3%. Frank's CAC 40 lost over 2%. The Maharlika Investment Corporation is looking to complete its entry into the National Grid Corporation of the Philippines in the first half of this year. MIC is moving to close its nearly 20 billion peso deal to acquire a 20% stake in Synergy Grid and Development Philippines, the holdings firms of NGCP. The binding term sheet requires the deal to be completed within 180 days from January of last year. So far, however, no official board appointments have been announced. If the deal pushes through, MIC will get 4 board seats, 2 in SGP and 2 in NGCP. The Philippine Sovereign Wealth Fund is leaning more toward hard assets as global risks and high energy costs reshape the investment outlook. As reported by Bloomberg, Maharlika Investment Corporation says tangible assets like metals and energy companies can better preserve value amid rising fuel costs. The fund has more than 75 billion pesos in investable funds and completed stakes in Makilala Mining and Asian Terminals, while eyeing deals in energy, agriculture, and mining. Norway's $2.1 trillion sovereign wealth fund says markets have stayed resilient, but may also be too complacent amid the Iran war. Fund chief Nikolai Tangen says companies have moved quickly to adapt to rising risks, citing more diversified supply chains and greater flexibility in managing costs. The fund, which invests Norway's oil and gas wealth in more than 7,000 companies worldwide, says markets have remained relatively steady despite building inflation pressures. But Tangen also warns that even as markets appear calm, global risks still require close watching. We're taking a quick break. Business 360 will be right back. Shares of luxury developer Shang Properties plunged 13% after a dividend error spooked investors. Shang Properties, controlled by Robert Kwok, quickly corrected the dividend to 0.1191 pesos per share, 10 times higher than the initial announcement. Shares recovered nearly 5% the next day, but failed to regain the early losses from the mistake. The incident drew comparisons to dividend blunder by Leisure and Resorts World in 2013, highlighting the risks of incorrect disclosures. Gotianon-led Philinvest Development Corporation posts 24% rise in its 2025 net income. The figure is now at 15 billion pesos, its highest net income in 70 years. The company says this is due to strong performance in banking, property, and power units boosted the results. More Filipinos are turning to electric vehicles amid soaring fuel prices and global tensions. Our mobility correspondent G. Baroga has the story.
Sales of electrified vehicles in the country accelerated in the first 2 months of the year. Data from the Chamber of Automotive Manufacturers of the Philippines Inc. or CAMPI shows sales jumped 67% to more than 5,700 units. One of the factors seen driving demand is higher fuel prices due to tensions in the Middle East. But according to CAMPI President Jing Atienza, this EV surge did not happen overnight. Speaking on Bilyonaryo news channel's Shift Happens, he says more consumers are now embracing electrified vehicles.
Yes, there's been some increase, a big increase actually in sales of electrified vehicles, but this has been an ongoing trend since maybe 2 or 3 years ago. You know, maybe 3 or 4 years ago, it was around 1% of the total market. Now it's around 10%. No, it's rapid growth.
He admits the broader crisis is affecting the car industry, but says much will depend on how long global tensions last. For now, the group isn't too focused on hitting its 500,000 unit sales target. Instead, the priority is helping consumers navigate rising fuel costs, and that means giving them more options. Charging infrastructure remains a hurdle, and Atienza says collaboration between the government and the private sector is key to addressing this. Business World motoring editor Cap Maceda Aguila agrees.
In the case of electrified vehicles, it really cannot succeed without the sign-on of either of these entities. We've seen also how the government has, through the years, given friendlier policies to importers of electrified vehicles and stuff like that. So it can't really be a group project though.
On the manufacturing side, Atienza is hoping to see more activity, especially given the sector's impact on the Philippine economy. There's also hope for a new program to support car manufacturing. The previous Comprehensive Automotive Resurgence Strategy or CARS program has wrapped up, while its proposed successor raise or revitalizing the automotive competitiveness enhancement is still on hold after its budget was vetoed.
There should be some targets, and there are targets set, but again, since it's not yet an official project in CAMPI, and of course Toyota and other manufacturing companies as well, would be ready to work with government to again have a best solution for manufacturing in the country.
This early, CAMPI and other industry stakeholders are already gearing up for the Philippine International Motor Show in June, which is expected to be the biggest yet with 22 participating brands. And like many, they're hoping that the global situation settles down by then. For BNC Mobility, G. Baroga.
The oil shock triggered by the Middle East conflict is now raising bigger questions about the Philippines' energy security, inflation outlook, and policy options. And to help us make sense of the risks and what the crisis is revealing about the country's long-term vulnerabilities, we're joined by Peter Liu, Dean of the School of Economics at the University of Asia and the Pacific. Good morning, Professor. Welcome to the show.
Good morning. Thanks for inviting me.
Professor, how serious is this current oil and energy shock for the Philippines compared with past disruptions, like from the 1973 OPEC crisis to the Russia-Ukraine war? What makes this episode different?
Well, for one, it's maybe the speed of the increase. It's at least in pump prices you can already tell. I don't know. I think for gas probably went up. And last time I gassed up, it was about near 60. Now it's about over 80. So Yeah, it's like one third already. I increased about 20-30%. Diesel probably even higher. That's also one thing that's different. In the past naman, you would have gasoline still remain higher price than diesel. But now it's the opposite. It's because diesel has a bigger industrial demand kaya across all countries. So that's why their prices are also higher now. Um, Although, which is not to belittle it though. I mean, by our computations, actually, if one considers the cumulative inflation to the U.S. dollar, for example, since the in 2008, actually the peak price was still higher for now. I think it reached about 140 dollars per barrel
Yeah.
in 2008. We're nearing that, but if you consider that was back in 2008, the dollar also is worth a lot less. No, so
Yes.
I mean, a dollar back then should be $1.60 today. So if you apply that computation, we'd have to hit about $220 per barrel today to kind of match that price.
But Professor, based on your observations and research, why is it moving much faster now?
Well, because this is a war. The one in 2008, which reached higher even than today for now, no. In 2008, kasi the rise in the price was more actually due to an increase, very good global economic performance. The world was growing fast, and so the demand for oil was rising. Pero the rise was more gradual because it was a demand pull thing. Today, it's a cost shock type. It's a war. So, and even from day to day, it fluctuates. It can fluctuate depending on, you get news lang that maybe a few ships pass through the Strait of Hormuz, and then the dollar, I mean the price comes back down to under 100. Then the next day, you have news of Iran hitting a facility somewhere
Yes.
in Saudi Arabia, and then it jumps back up. So it's a lot more volatile this time as well.
And at what point does a spike in oil prices stop being a short-term shock and start becoming a broader economic problem?
Well, unfortunately, in this episode, no, kasi this is war, and of course, like in most wars, as it seems they're beginning to do now, they're beginning to target the oil and natural gas facilities as well. So that kind of damage will take longer to repair. Unlike in 2008, that it was not primarily a parang question of damaging physical infrastructure of producing oil and gas. It was more of excess demand. And so when, I don't know if you would say providentially good, the next year we had the Shearson Lehman, the global financial crisis, which dropped global economic activity. Then prices came back down, came back to more normal levels. But there was not much destruction, if any. There was no physical destruction of facilities. What I see as a problem today is that this is war. So the infrastructures are being even targeted. So, and to repair that, well, even assuming the war ends soon,
It will take time, yes.
Time to repair.
Now, Professor, how vulnerable is the Philippines to a prolonged disruption in the Middle East supply, not just in terms of fuel availability, but also pricing power?
Well, for sure, we're going to take a hit to inflation. We will see it in the official statistics pretty soon. When I looked at some of the past oil shocks, including, besides 2008, there were also other years where oil prices also went up. But 2008 was the highest so far. The inflation would go up maybe over double digits. In 2008, I think the inflation went up above 10%, but because of a combination of a rice crisis back in 2008, food prices actually even went up faster than transport inflation. So, of course, food is probably, arguably, maybe for most people more important, the inflation there. But at its highest in 2008, given that it was combined pa with the rice crisis, if I recall, the food inflation was maybe something like 17 to 20, near 20% inflation. So that's bad, and especially on the poor, because food would be a priority for them. So if it's prolonged, the suffering of households will be higher, will be more severe. And then there is also the possibility of what we call a problem of stagnation. No? So in economics, you've got stagnation, you've got the combination of high prices, high inflation.
Yes.
And at the same time, economic activity, GDP slows down. So there is a risk of that if this happens long enough. Not just in the Philippines, but even all over the world, which means since we're even more connected globally ngayon, mga economies natin, that makes the damage from a stagnation a bit more worrisome.
Now, Professor, the Department of Energy has mentioned alternative suppliers such as Russia, the U.S., Canada, and South American markets. Now, when the Philippines looks for alternative fuel suppliers, what factors matter the most?
Well, obviously prices, but if you're coming from that far, once you factor in the transport cost, and it will take longer to get here, of course. I'm not sure it will. Well, I haven't crunched the numbers. I'm sure the DOE has done their numbers. But the other thing also I think is that local oil companies would have done their numbers as well, especially if they're importing. Actually, all of us do import. All of the local industry imports. Petron has to import oil. Petron is the only one that has a refinery, but Petron also imports finished products. Everybody else is importing finished products. My guess is that they've all done their homework. I mean, even before the crisis, Siyempre, what business would not try to find the cheapest raw materials that they can, right? So I presume they've done. These oil companies have probably done their canvassing, and they source from wherever they were sourcing, which is. For the refined product, I think mostly within the area here.
Yes.
I think for the crude oil, I think it mainly comes from the Middle East. So hopefully that they can still find some bargains out there, but probably not likely to be very significant because oil is globally traded. So,
Yes.
so arbitrage would come in. So you couldn't, I mean, it might be cheaper somewhere, but it's maybe for us because it's farther away, so
logistics-wise, it could also be much higher. But Professor, looking at it from an energy security standpoint, is diversification enough, or does the bigger vulnerability remain the country's basic dependence on imported fuel?
Well, diversification takes time. I mean, I remember very much, was a young boy back then, the first oil crisis of the 1970s. At that time, most of our electricity was actually generated from oil. I just remember distinctly my dad coming home one day and saying, okay, no more aircon for us when we sleep at night because the electricity prices had kicked up. But today, for example, now, electricity is not that reliant on oil anymore. Mainly lang sa machinery. And what was the reason? Diversification, but that took decades. We saw oil is expensive to generate electricity from, so there has been a shift away from it. I noticed that before this, you were talking about electric vehicles, your program. Maybe one fortunate thing for us is that we are at a point in human history where electric vehicles are now feasible. And actually, some of your guests in that segment were saying it was rising very fast. So that's another diversification.
Something we can look into.
Yeah, then it looks like you've been looking into. Because oil, the main use today is really transportation. It's not used so much anymore for electricity. So our Achilles heel really is the transportation. So if you can find alternatives to oil products for transportation, then that would be one way of alleviating it.
And so, professors, during these trying times that we're facing, what policy responses actually work best in cushioning a shock like this, and which ones sound attractive politically but offer limited economic relief?
Well, I've seen in the news media now there are talks of taking out the excise tax.
Yes.
On fuel products. It seems to be a very commonly, in principle, one could do that for a short time, but there is the equity issue of it. Because if you take out the taxes, then the pump price comes down, but it comes down for everyone. including people who may not really need as much the assistance that otherwise, if the taxes had been collected, then one can take the money and then target it at those sectors that are more in need, the very poor, the transport sector.
But Professor, looking at it from an economic standpoint, how much relief can suspending or reducing the fuel excise taxes really provide, and how should policymakers weigh that relief against the loss of government revenues?
Yeah, I'd have to look at the very detailed numbers, but if my memory serves me correct, I think the excise tax on diesel might be something like around 4 pesos. I don't know it exactly. So, but you're looking at maybe 4 to 5 for diesel reduction. Today, it's already 100 pesos per liter. So I'm not sure for, at the pump, if that's really gonna matter a lot. Gasoline, I think the excise tax is higher, maybe 8 pesos a liter. I have to review again. But at 80 pesos, okay, well, that could still be some savings. But as I mentioned, it's more the equity. Kasi most of those using private vehicles, I mean, they will also probably not really, I mean, it will hurt them. I mean, right now it's hurting them. Even the middle class, because a significant portion naman of the middle class probably is riding motorcycles, if not motorcycles, cars then, diba? So it's hurting them. The other possibility that occurred to me actually that we did under the COVID, diba, we work from home. And I've heard some private companies are starting to kind of be more flexible, go back to that again.
The 4-day work week, yes.
That, or even just work from home when possible. That would save the transport cost of their employees. That's also some amount of savings from the point of view of the workers, not just fuel but also time, given the problems that we have commuting. So that's beginning to look more attractive also as an alternative. Well, in terms of diversification, of course, you've got renewables, but maybe it's
in terms of renewables, Professor, are we there yet? Is that enough? Are we moving the needle when it comes to renewables?
I think that there seems to be well, in terms of in transportation, there's a natural diversification towards electric vehicles. It looks like also a bit, it's beginning to, we're on the cusp maybe of, at least for residential households. But this is more upper income then, upper middle income, because the cost of installation is not something that, would immediately be affordable for the lower middle or the poorer segment. But whereas beginning to see more people rely on solar panels also for electricity. For base load, it's a little bit more difficult to go renewables because they're variable, like solar, intermittent. So you still need the...
So those are good alternatives, at least for now, to at least soften the blow of what we're going through.
Yeah.
But Professor, this crisis has also revived calls to scrap the oil deregulation law. Now, as a member of the 2005 panel that's reviewed it, what is your response?
Well, even back then with the commission, we were saying, well, if in case of emergency such as perhaps, well, we have a problem now. I wouldn't say it's an emergency yet, but technically the oil deregulation law has a provision, I think, for that that the government could step in. But see, the root of this is abroad. The price, we really don't have much control over that. And besides that, for me, the oil deregulation, the benefit has been the great influx of competition it's brought in. So, and that has a pressure in terms of competition, keeping prices maybe from going way too high, So, and also the supply, the more new, just the amount of new players that you have today, right? They're also importing, so you've got also an alternative set of new competitors who are also bringing in supply. So it helps. I'm not really sure what the objective would be with repealing the oil deregulation law.
Or just looking into it and seeing which works best now with what we're going through.
Right. The competition was certainly something that worked well with the deregulation. Now, what's happening now is kind of, it's not a normal thing. So parang sobra naman maybe to repeal a law that, in my view, overall achieved its objective for what hopefully will be a temporary situation, right? So, yeah, I think naman the government would have, not just in the deregulation law, but probably in the Constitution, maybe, the ability to come in and control prices if they had to. But when you control prices, then if you're gonna set prices lower than market, somebody's gonna have to subsidize that. So I mean, somebody has to pay for that. That's going to be the government, and then indirectly, that's us really through our taxpayers' money. It will be spent on that. Rather than maybe on other items that we still need to spend on in order to keep our development trajectory.
And Professor, now looking at the central banks, have the central banks, including the BSP and the US Fed, responded correctly so far, or are they still underestimating the inflation risk from energy?
Well, I saw news the other day that I think the Fed is probably not going to lower rates anymore, perhaps even raise. I think I saw news also that even locally we're looking at that. Now, from a central banker standpoint, that's the normal reaction, no? If you fear inflation, to raise rates. But the reason for raising rates for monetary policy, the idea is that by higher interest rates, you discourage some spending. In our case, I imagine it's more you hope to discourage the investment spending because higher interest rates will discourage investment spending. And that's how monetary policy hopes to keep inflation in check by actually reducing demand for goods and services. No? The irony is that, and I can't blame them because that's their hands are tied. That's all they can do. But the root cause of this problem is not a demand problem. It's a supply thing. It's a cost shock, yes. Which it's not really going to get at it. But it's kind of like a second best type of a thing you do. I mean, to reduce inflationary pressures, you reduce what we call the aggregate demand, no? The demand for total goods and services, which a higher interest rate we hope will do. But it's sort of like
But is that enough?
It takes time. Monetary policy interest rates normally takes time to take effect, no? And it's not addressing the root cause. The root cause is really the increase in the cost of oil at the source. But I can't fault monetary policymakers or the central banks here or abroad because that's typically the standard tool in their tool chest to combat inflation. But it's kind of addressing stuff. It might even work. It has to be balanced, no?
Yes. But you mentioned, Professor, that it will take time for these things to happen. But is it time that we have?
I think that one. I think anybody's guess is as good as mine as to how long this war will last. So, if it lasts long, the damage could be severe, and then the increase in costs could be a bit more permanent. And if it's just inflation that we want to fight, then that might be, at least on the monetary policy side, that's what we do. It actually carries also a risk of stagnation. I mean, meaning we might get slower economic growth. At the same time, one wouldn't, hopefully, it does its share of keeping inflation lower than what it would be, but I don't think we really probably will look at inflation shooting up.
Okay, Professor, finally, if I was your student looking for your advice, what top 3 factors or numbers should I keep watch?
Obviously, the inflation. Then, standard for economists, of course, we also are interested in the GDP. Kasi That's the unfortunate thing. No? We're already coming from slower GDP growth. So as I said, you want to balance you want to probably raise policy rates in order to stem off inflationary pressures. But if you do it too much, then you have the problem of stagnation. We probably still have high prices there will still be some inflation. Because the cost of oil, especially if the war is prolonged, will remain high. So, and we're not really addressing that when we raise interest rates, and we're not addressing that root cause. So at least those two things is what I'd be looking at, the inflation rate and the GDP growth rates.
On that note, thank you very much, Professor, for your insights and taking time this morning.
Thank you for having me.
Meanwhile, K-pop powerhouse BTS is now making its comeback, potentially edging out Taylor Swift's record-breaking Eras Tour. Earnings from BTS World Tour include a new album and a Netflix livestream deal. This is projected to surpass Taylor Swift's concert tour from 2023 to 2024, which raked in a record $2 billion. Bloomberg estimates that an upcoming BTS concert in Seoul alone could generate $177 million. While the tour is expected to bring in over $800 million from tickets and merchandise, as for tourism, analysts are projecting that travels, hotels, and local businesses will see surging demand. Manila is one of the legs of the BTS World Tour in March 2027. And that's it for Business 360. Sitting in for Mikey Oreta, I'm Robert San. Thank you for joining us. Keep it here on BNC, the Bilyonaryo News Channel.